The United States national debt has been a growing concern for decades, with the current total exceeding $28 trillion. But can the US ever pay off its crushing national debt? In this video, we'll explore the history of the national debt, the factors contributing to its growth, and the potential consequences of not addressing it. From the impact on the economy and individual taxpayers to the role of politics and fiscal policy, we'll examine the complexities of the national debt and the possibilities for reducing it. Whether through increased taxation, spending cuts, or economic growth, we'll discuss the potential solutions and the challenges that come with them. Join us as we delve into the intricacies of the national debt and explore the possibilities for a debt-free future. Join me as I dive into the crazy challenge of figuring out if the US can actually pay off its massive national debt. The concept of national debt and its implications is a complex issue that has been debated by economists and politicians for years, with some arguing that it's a necessary evil to stimulate economic growth, while others claim it's a ticking time bomb that threatens the country's financial stability. The current state of the US national debt is staggering, with a total debt of over $28 trillion and growing at an alarming rate of over $1 trillion per year. This massive debt is a result of decades of government spending exceeding revenue, with the majority of it being held by foreign governments such as China and Japan. The debt clock is ticking, and it's imperative that we understand the severity of the issue to even begin thinking about potential solutions. The US national debt is not just a numbers game, it has real-world implications on the country's credit rating, interest rates, and ultimately, the economy. The US national debt has been a growing concern due to its rapid and continuous increase over the years. Many experts and policymakers worry about its long-term impact on the economy. As the government borrows more to cover spending beyond its revenue, interest payments on the debt also rise, putting pressure on the federal budget. This can limit investment in essential areas like education, infrastructure, and healthcare. A high national debt can also affect investor confidence, potentially leading to higher interest rates and reduced economic growth. If foreign investors start to question the government's ability to manage its finances, they might demand higher returns or pull back from purchasing US debt altogether. This scenario could put additional strain on the economy. Another concern is that future generations may bear the burden of today's borrowing. Without strong measures to control spending or increase revenue, the debt may reach levels that are difficult to sustain. This growing concern has sparked ongoing debates about fiscal responsibility, tax policy, and the role of government in managing the economy. As the debt continues to grow, so does the burden on future generations, who will be responsible for paying it off. The national debt is a result of a combination of factors, including government spending, tax policies, and economic conditions. Government spending is a major contributor, with programs such as Social Security, healthcare, and defense accounting for the majority of the budget. One way to address it is by reviewing and prioritizing federal expenditures, focusing on essential services while cutting down on wasteful or redundant programs. Improving the efficiency of government operations can also help reduce unnecessary costs. Another step is to reform entitlement programs such as Social Security, Medicare, and Medicaid to ensure their long-term sustainability without placing excessive pressure on the national budget. Encouraging economic growth is equally important, as a stronger economy leads to higher tax revenues without raising tax rates. This can be achieved by supporting innovation, investing in workforce development, and creating a business-friendly environment. Tax reform can also play a role by closing loopholes, simplifying the tax code, and ensuring that all sectors contribute fairly. Strengthening fiscal rules and enforcing budget discipline through long-term planning will further help keep spending in check. By combining smarter spending with strategic revenue measures, the US can work towards stabilizing and eventually reducing its national debt. Tax policies also play a significant role, with changes in tax rates and deductions affecting the amount of revenue generated. When tax revenues fall short of government spending, deficits grow, adding to the national debt. Tax cuts that are not matched with spending reductions can widen this gap, especially when they reduce revenue from high-earning individuals or large corporations. A well-structured tax system is essential for maintaining fiscal balance. Policies should aim to generate enough revenue to support public services while promoting fairness and economic growth. Closing loopholes and improving tax compliance can help recover lost revenue without increasing tax rates. Adjusting tax rates carefully, particularly for those with higher incomes or large profits, can also contribute to debt reduction if managed responsibly. Tax incentives and credits should be evaluated for their effectiveness and cost to the government. Over time, smart tax policies combined with controlled spending can help manage the debt more sustainably and ensure a stronger financial future for the country. Economic conditions, such as recessions and boom periods, also impact the debt, as the government often increases spending during downturns to stimulate the economy. Factors such as demographic changes, like an aging population, also put pressure on the debt, as more people rely on government programs. The history of the US national debt is marked by periods of significant growth, followed by brief periods of decline. The debt has been growing steadily since the 1980s, with a brief period of decline in the late 1990s. This decline was short-lived, as the debt began growing again in the early 2000s, driven by increased government spending and tax cuts. The debt has continued to grow since then, with the COVID-19 pandemic accelerating the growth. To put this into perspective, the US national debt has grown from around 10% of GDP in the 1980s to over 130% today. Historically, there have been instances where countries have successfully paid off their debt. For example, the US paid off its debt after the Revolutionary War, and again after World War II. Historically, countries have successfully paid off their debt through a combination of economic growth, smart fiscal management, and strategic policy reforms. One common approach has been to grow the economy, which naturally increases tax revenues without raising tax rates. A larger economy generates more income, more business profits, and more consumer spending, all of which help boost government revenue. Governments have also focused on spending discipline by reducing unnecessary expenditures and prioritizing critical investments that support long-term growth. Some countries have introduced budget rules or fiscal frameworks to limit deficits and control public debt levels. Tax reforms have played a role too. By broadening the tax base, improving collection, and closing loopholes, governments have raised revenue more effectively. In some cases, countries have implemented temporary tax increases during periods of high debt with a clear plan to phase them out once fiscal health improves. Debt restructuring or refinancing has helped in certain cases, allowing governments to negotiate better terms, extend repayment periods, or reduce interest costs. Inflation has also played a quiet role in reducing the real value of debt over time, especially when paired with strong economic performance. The key to success has often been a combination of consistent growth, transparent policies, political commitment, and the ability to adapt to changing economic conditions while maintaining public trust. However, these instances were often accompanied by significant economic growth, inflation, or a combination of both. In the case of the US, the post-World War II period saw rapid economic growth, which helped to reduce the debt burden. Other countries, such as Australia and Canada, have also implemented successful debt reduction strategies, often through a combination of spending cuts and tax increases. The US could potentially learn from these examples and implement similar strategies to reduce its debt. The potential solutions to the US national debt are complex and multifaceted. Some argue that the government should prioritize spending cuts, focusing on areas such as defense and entitlement programs. Others propose increasing tax revenue, through measures such as a wealth tax or a carbon tax. Another approach could be to implement policies that promote economic growth, such as investments in education and infrastructure. Additionally, some experts suggest that the US could consider debt restructuring or even monetizing its debt, although these options are highly controversial and come with significant risks. The US national debt is a complex issue that requires careful consideration and analysis. The debt has grown significantly over the years. To address this issue, the US will need to implement a comprehensive strategy that includes spending cuts, tax increases, and policies that promote economic growth. The key points to take away are that the national debt is a serious issue that requires immediate attention, and that potential solutions will require careful consideration and coordination. The US national debt issue is complex and multifaceted, with no easy solutions in sight, so let's keep the conversation going in the comments below. What do you think the US can do to tackle its massive national debt? Be sure to check out our next video, where we'll dive into another pressing economic topic.